thanks for being with us. We want to take a look at managing our money here, and there's a difference between actively managed funds versus an index fund or an ETF, for example. Can you explain some of the differences so folks understand, Brett?
Of course. Thanks for having me, Nicole. Yeah, so active management, just kind of on the basis, is much like the name, active. There is a team that is behind it that is actively making changes, adjustments. One of the nice things about active managed funds is the ability to make changes based upon current events. A lot of the things that happen today, a lot of things have been happening over the last several weeks. And an active manager can be getting in and out and doing the research with his team to say, hey, these are the best picks. And the whole goal of an active manager is to beat a particular benchmark. They want to beat what the market is doing. That is their goal. Now, there's a risk of that. The risk of that is that they make mistakes. They do research in an area, or they find some position and something changes, and that could put you on a risk side where you could actually underperform those markets. Versus the passive side. The passive side is your S&P 500 index or your NASDAQ. It's following a particular index that says, hey, this is a set of stocks. It is what it is. It's very passive. It doesn't change. There's nobody managing it. So that's the big difference there. Some of the other key things you want to look at, the difference in active is there's potentially a cost difference. Because they're doing regular transactions, they're adjusting in the portfolio on could be a day-to-day basis. There's a cost associated with that, with ticket charges and so forth. So the internal cost of an actively managed fund will typically be higher than a passive fund, or the funds that we see, in a Vanguard, 0.004, expense ratio. The other side of it is the tax consideration. Tax is a big part of it. You want to make sure that if you are doing active management, you understand that that manager is creating capital gains, is creating dividend distributions. And so if you're doing active managed funds inside of an after-tax account, you have some tax considerations that you need to be thinking about. So usually it's suggested, if you're going to use an active manager, try and sprinkle that into more of your pre-tax accounts like your 401ks, your IRAs.
Right. And I mean, it's also your tolerance for risk and how you sort of play this or set this up, I guess. We've had an extremely volatile market. There's no secret there. And for example, we're not far off from the highs. I mean, we're 5-6% off our highs. So while the market seems like a big disappointment here in the third quarter, because both the NASDAQ and the Dow finished down for the quarter, the truth of the matter is we're only down 5-6% off the highs. That's not terrible at all. So what is someone to do as they look and consider the pros and cons of an actively managed fund versus the others, particularly in these times where it feels so like we've sold off so much, but still we're only 5-6% off the highs. Is there one better than the other at this point for certain people, and why?
I don't know that one's necessarily better than the other. That's actually the long-lived discussion is active better than passive? Passive's better than active. I mean, this debate has been going on for a very long time. And, depending upon the period of time that you're looking at and comparing, there's an argument for both sides. So I typically tell people there's a reason to have both. There's a reason that you have an S&P 500 fund. There's a reason that you go and you have an active manager in a particular specialty sector or a specialty industry that they are the experts at that. And it gives you exposure and opportunity because, remember, their goal is to beat the market. And so you want to have some of that sprinkled in, and figuring out, it comes really back down to the bigger plan. What is your overall plan when it comes to your investments? Are you long-term focused and you're trying to save and set up for your retirement that's 20 or 30 years from now? Are you in a position where you're already in retirement and you're looking for more of that safety and protection? Well, maybe you're looking for an active manager that is going to actually protect you on the downside. They're going to be actively looking for those bond funds and positions that are, hey, we're going to set you up so that you have very little risk in your portfolio. So it really is dependent upon your situation. What are you trying to accomplish? Again, you've got the type of account you're in. Are you in qualified accounts that have never been taxed, or are you in accounts that are after tax money and you have tax considerations to think about? So how to invest and what to choose, and especially as you pointed out, with where the market is today and what we're seeing right now with the volatility, it could make sense to look for a little bit of active nature. It's very common that we just invest in the passive funds and we pick a target date fund or an index that we're just going to follow. But maybe you should, with this volatility and going on, as an individual investor, it's very difficult to understand all the things that are happening and all the moving parts. But if you can focus on the passive side yourself, that's pretty straightforward for most investors, and let an expert focus in that area that's more actively managed.
And the truth is, when you look at the different times here, I mean, just a final quick thought on the market. I mean, you've been in the business a long time and we move going forward. Is there a final thought here as to where we stand as investors and the environment we're in versus the past or the future?
I think a perfect point on that is every one of us is different, and we can't let the past, dictate what we're going to do in the future, and we can't let emotions get in a way of how we're doing in our investing. You hit it spot on. The market has been a little crazy lately, but if you really look at it, it's not that far off of the highs. So what else is ahead? We've got a lot coming down that could impact us. So think about your ultimate goals. Where are you trying to move with your portfolio, and let that be the driving factor of I need safety and protection, or I need growth because that's really the area I want to be in, and talk with a professional about it and see how they can maybe give you some additional thoughts.
Brett Gottlieb, thank you so much. Great to see you. Thank you so much for that. President
Thank you.
and founder of Comprehensive Advisor.